All right, so as we move into our portfolio update, before we get into all the KPIs, a couple of quick announcements. We did have 2 acquisitions in the first quarter of 2026. The first one being in Murfreesboro, Tennessee, 267 units built in 2001. This is a property we had been working on for several years with a local family. The grandfather was the original developer of the property. It's been in the family ever since. It's never traded outside. We had built a rapport with the grandchildren of the original developer who took the property over about 2 or 3 years ago and then began to kind of clean it up a little bit, try to modernize it. But after a few years of being hands-on owner-operators, they decided they wanted to sell the asset and go pursue personal interests. So we were the first call, which is something that we worked hard to be over the last 3 to 4 years in building the relationship with them. We helped them, give them some advice, made some introductions for them as they were running their property. This is about maybe 10 minutes from Farmhouse Apartments, 288 unit property that we developed down in Murfreesboro, Tennessee. The opportunity for us gave us real economies of scale in the market that we know really, really well and are very long-term driven on. So this is a market that checks a lot of our boxes. Challenging to build meaningful supply, sits inside of Rutherford County, one of the top counties in all of Tennessee in terms of growth and jobs. Zoning is very tough. Rezoning is very tough within Murfreesboro. So I think there's one garden deal under construction and one mid-rise deal under construction. The mid-rise is about 15, 20 minutes away, and the garden deal is probably about 15 minutes away in this market. But good schools, good quality of life, good neighborhood, just a really, really great submarket that sits about 30 minutes southeast of Nashville and has become its own market. It used to be kind of a commuter town to Nashville, but Murfreesboro, Rutherford County as a whole, tons of jobs there, diverse employment, like I said, good schools, good demos. It's a market that we are long on. So it was a great opportunity for us to acquire this asset that really has been run family owned since inception. And it's 25 years old. It's 2000s newer. It's definitely workforce plus type property, but we believe that we can come in there, bring professional management, professional service, begin implementing our operating standards to the property, make some necessary improvements to the amenities, they had started a unit renovation program, continue doing that, adding in, standardized other income charges that are commensurate with the market that were not being charged at all, utility charges that were commensurate with the market that were not being charged at all, and really create a great kind of workforce plus gray collar community here for the long term. And it pairs well. It gives us, nearly 600 units within 10 minutes of each other, where we can have staff assisting one another, referring prospects to one another, because it is different. Our rents at Farmhouse are pretty materially higher than the rents here. So if someone comes into Farmhouse, doesn't qualify for that, we can say, hey, why don't you go see our sister property? Somebody wants to elevate out of this particular property, move to a step-up property, we can refer them over to Farmhouse, etc. So excited to add this one to the portfolio. It was a long time coming. The next acquisition that we had was in Atlanta, which has been a market of focus, as I referenced earlier. We spent about a year plus focusing on Atlanta, looking at multiple opportunities, and we actually had offered on several deals in and around this particular property, Grove at Greenleaf, which is in Conyers, Georgia. We'd offered on probably the top 2 comps to this over the last year. So we got to know the submarket really well. When this came out, this was a part of a public REIT liquidation. So they had sold off about 19 properties to a large institutional firm. And then they had about 7 left that they were liquidating and launched on market, I'd say around November. So it was a little bit of a clunky process through the holidays. We had our eye on this one and focused really primarily on this. And we believe we were able to tap in and get a really great buy here on an institutionally owned asset 240 units built in 1999 that was really operationally distressed, physically in great shape. They'd invested close to $2.5–3 million over the last 5 years. Grounds were great pool, great pond, as you can see, great amenity package, good unit mix, well-maintained property. However, given the public nature of the company and the liquidation, they weren't able to retain staff. So you saw operations really deteriorate over the last year, where the property was running about 20% vacant, where we felt that we could step in again, bring our management team in, invest some capital into the asset, get the property stabilized, and have a really attractive basis with a good cap rate upon stabilization. One of the lowest purchases probably, for this vintage product in the last 2 years that's gone on in and around Conyers and Covington. So really, really happy with those purchases. Okay, so now we're going to move into our KPIs, the portfolio overview for the first quarter. So just to recap, the URS portfolio includes 17 properties, about 3,400 units across 5 states, as you can see here: North Carolina, South Carolina, Tennessee, Georgia, and Maine. We're going to cover the KPIs that we're tracking consistently for the last now 12. This is our 13th quarter in a row tracking this. So if you ever want to reference back, everything's housed on our YouTube channel. There's a playlist dedicated to all of these reports are there. Again, this is in an effort to provide total transparency to our investors, to those considering investing with URS, and our industry peers, whether it's brokers, lenders, colleagues in the space, to provide real-time data on what we're seeing in our market. Obviously limited portfolio, but sizable in and of itself, to give a little bit of insight to what's going on. So, as we move in, first quarter anecdotally was not that great, which you're going to see here. And, again, we provide real numbers, real data here. So we don't sugarcoat or try to manipulate the data. A little bit of holiday hangover, tough winter, even down south, having snow, freezing cold. It just prohibits moving, prohibits leasing, higher maintenance costs, things of that nature. So a little bit of a tough first quarter, but some bright spots nonetheless. As we shared earlier in the part one of it, we did see positive absorption, across from a national level in terms of supply for the quarter and units absorbed. So we're all excited for the spring leasing season as it kind of kicks off in April here. We're living it. We're seeing traffic start to pick up. And we did have some bright spots we're going to touch on here as well. So we started top down, focused on occupancy, basically tours, leases, and occupancy for Q1 2026. So let's start with our leads in total. So broken down into 3 baskets: our stabilized assets, those that we've had over a year, recently acquired, those that have been acquired within the last 12 months, and our developments and lease-ups that are active. As you'll see here, Cypress Point is our development in Mooresville. That's not included in these numbers. We just got our TCO for our clubhouse and began pre-leasing. So you'll see those numbers start to hit in the second quarter. But focusing on stabilized first, you can see here across 11 properties, we had almost 4,300 leads, 638 tours, 328 net leases, and we closed out the quarter at 93.4% occupancy. That's down from 95.2% occupancy in the close of Q4. For our recently acquired assets, again, this is now including newer assets that we acquired, the Murfreesboro and Atlanta properties. So again, if you remember, reference, the Atlanta property was in the very low 80% occupancy range. That's now included in these averages. So we have 4 assets, 912 units. We had 703 leads, 139 leases, 38 net, resulting in a occupancy of 91.1, which is down from 95.1. Again, keep in mind, we had 2 assets that we acquired that hit their 1-year anniversary that rolled off from recently acquired to stabilized in Q1. And then we brought 2 new assets that were literally just acquired within the last 2 months into that recently acquired side. The developments in lease up, that's the Ash, 319 units in Asheville, and Cypress Point, 180 units in Mooresville, North Carolina. 601 leads. This is primarily all the Ash. 70 tours, 46 leases. Occupancy closed out at 45.1, up from 34.8. Obviously, we want to see that continue, that continued incremental growth. We'd love to see, 10 to 12% plus occupancy growth quarter over quarter. That would put us on pace here to get to stabilization over, call it the next, 3 to 4 quarters. Ideally, we catch a couple of 15% months in terms of the busy leasing season. Would be nice. And then next up here, we break out the occupancy. Again, tough to follow. There's a lot of data on here, but, big movers. Creekside Arden is part of the Creekside 3-pack. This is a little bit artificially beaten up. So smaller property, about 70 units. We did have a hot water tank blow there, affected 3 apartments there. So that's been offline. We had another issue at another down unit at that property. So in effect, we had 4 units completely offline on a 70-unit property. So that's material in terms of occupancy. So that's a big driver there. The rest of the portfolio were nominal moves. Use it Riverbend did have a tough quarter, coming out post kind of holiday hangover, 92% to 88.7. That's starting to pick back up. We're battling new supply there. It's a smaller market in Beaufort. 2 new deals opened up within the last 6 months there, giving away 3 months, of concessions. So our team is top notch there. I couldn't be more proud of what they're accomplishing. It's not a market thing. It's not a people thing. This is really short-term driven. You have a smaller market like Beaufort, gets 2 deals going through a lease up. It's going to have an impact. I think we're doing as good of a job as we can be doing for the submarket. And I really truly believe that across the board with the amount of deals that we underwrite and the amount of brokers that we talk to on a daily basis. I know we are not perfect by any means, but I think we strive to be at the top end of every one of our submarkets in terms of performance at the property level. And some of the submarkets are going to be a 90, 91, 92% submarket right now because as supply is getting, absorbed. That just is what it is, but we want to be at that 92. I don't want to be at 75, 80 like some of our competitors are. So again, the occupancy story, some of this does go lockstep with, rents. If you're willing to kind of, we managed occupancy really well in Q4 to put us in a good position in Q1. I think we held pretty firm across the board, given some of the challenges that were in the market. But overall, not any other like major movers that were very alarming. A couple of percentage points here and there. And a lot of these are beginning to trend back to, those Q4 numbers as leasing velocity picks up. We also had a, really, really strong Q4. That was, we positioned ourselves very well. So on the recently acquired and development side, you could see Palms at Edgewater, 95 to 93. Some of that has to do with evictions that we're still working through. Again, being within our first year of ownership, we knew there was going to be a meaningful amount of turnover at that property. We're getting to that other side just as we hit our 1-year anniversary there. So that should start to normalize. Towns at Pryor, recent takeover, I think we closed, I want to say around October, give or take. So nothing concerning. We are doing a pretty meaningful value add there. We bought that from a very long-term owner. Property was severely under-rented relative to market. So we did some renovations to the grounds, the amenity spaces, and we're doing a very high-end renovation given the size of the units. They're townhome-style units to select few units. So those units are brought offline for 30 to 45 days. The ash I touched on earlier. We've got some incremental, about 10% for Q1 during a relatively slow leasing period. Very happy. The team there did a really good job through Q4 and Q1 and a challenging winter. I mean, Asheville had real snow. They are in the mountains there. So through the challenging winter, pretty happy with the results at the Ash. So now looking at the lease tradeouts across the board, again, following the same format, stabilized units first. We had 149 new move-ins. Move-ins in the previous quarter were 175. So again, down. That's a direct result in occupancy being hit a bit. However, pricing held, pretty flat to up 0.3% on new leases. And we had 269 renewals that were done and 145 move-outs. And the average increase on our renewals for the stabilized portfolio was about 3%. So some bright spots there. We're seeing pricing firm up in some of our markets. That's going to ebb and flow. We use revenue management. We stay really dialed in on pricing, and we're constantly looking at our 30, 60, 90-day trend. And again, as I've alluded to earlier in prior quarter updates, we are more focused on occupancy in the short term and keeping the assets stabilized versus pushing rents in the near term. We do believe we'll get the accretive rent growth as supply begins to normalize, and we want to position our portfolio to be in a place of strength when that time comes. So as we continue to see consistent data where we're getting, incremental positive tradeouts on renewals and new leases, if we're well occupied, we can be even a little bit more aggressive to recapture some of that rent that we had to give back to the market in exchange for occupancy. Recently acquired portfolio, 19 move-ins, average increase on those about 7.3%, 43 renewals, 6.5%. Now, most of that is attributed to towns at Pryor. On the recently acquired side, we're getting about 18.9% on those trade outs. Palms at Edgewater, we gave back a lot of rent to deal with the massive amount of turnover that we expected in the first year. We did cut rents to build occupancy. However, we did see positive trade outs there, about 2.6%. And obviously, the most recent two deals are excluded from this that we literally just acquired. So we're seeing really healthy trade outs on the renewals as well there. Just showing you the move-ins here that we've had on a per asset breakdown for the quarter. Some big movers to the upside, Crescent Place. We had a little bit of an occupancy dip there. This was backfilling. We've solidified our team there. We've got one of the best teams in the entire portfolio, from my view, that is now firing on all cylinders. We're fully staffed there for the first time in a long time. It's been a challenge in that market to get really good people and to get them to commit for the long term. And we've got a great, great team there, and we're seeing it. We're seeing the results directly there from their efforts. Latitude South Portland, down, not unexpected. Given again January, February, March up in Portland, Maine, and we try to manage expirations accordingly. And we've been doing a really good job kind of smoothing out our expirations and trying to eliminate being overexposed in that kind of December to end of February, really November to February range, and pushing those expirations into March through September, October, pre-holiday. So that's a lot of kind of the movement here and the management of expirations and move-ins here. Recently acquired move-ins to note here, Palms at Edgewater, compared to prior quarter, we had much less expirations and maintain a higher occupancy, so therefore lower turnover going into Q1. Towns at Pryor, new property, again, 6 move-ins versus 2 the prior quarter. And then the Ash, pretty much in line with Q4. We had 39 in Q4, 40 move-ins in Q1. So nothing too meaningful there. We're excited to get into Q2, spring leasing, Q2, Q3, really kind of see how velocity picks up. I think that's going to be a good indication in terms of how this year ends up. Our bad debt, this basically summarizes our bad debt rent write-offs for quarter over quarter. You can see here we haven't had any real material moves to the downside here. We had some good improvements on the stabilized portfolio, recently acquired, pretty immaterial overall bad debt for rent as percentage of GPR closed out about 1%. Feel pretty good about that. We do monitor our demos on a consistent basis once a quarter. I like to do a scrub of all the household incomes, credit scores, etc. Of our properties, and our tenants have really held up for the most part, knock on wood. We haven't seen, that varies depending on the asset profile. It's going to move, between 0.25 point to 3%, depending on the asset profile and the demographics that are attached to that. But, nothing too material at this point. You can see here, this just shows you kind of the moves per property quarter over quarter. Again, gray being Q4, blue being Q2. So you can kind of see where the bad debt is being attributed to. Nothing too dramatic in either way, like a Creekside Arden, again, smaller property. Looks meaningful and big moves, but you're talking about 2 evictions there on a smaller property in the fourth quarter that drove that. Now coming back in line. Crescent Place, pretty consistent, 232 unit, 1970 property. We expect that to run in the 2 to 3% range. That's not surprising, but you could see the newer assets. The latitudes at South Portland, Exchange at Rock Hill, Farmhouse, Belmont, really, really solid collections. Even the Creekside portfolio, Flats at Leland did a great job, closed out the quarter with no bad debt. No major concerns at this point on that front. That does ebb and flow throughout the course of the year. Some quarters are going to be better than others, but feel like we're in a good spot thus far. And then next up, this just shows you again the recently acquired for Palms at Edgewater. We expect this to bounce around between probably 1.5% to 2.5% for the first 24 months as we work our way through the entire rent roll. We knew coming into that deal that prior ownership was a smaller merchant developer. They're not operators. They had been trying to get the place stabilized and filled it up with less than qualified tenants for the quality of the property and location. So we knew we were going to have some meaningful turnover in the first 24 months. So we expect that to be kind of in line, with that 1.5% to 2.5% for the first 24 months, and then kind of normalize out at about 1% once we're stabilized. Okay, so now jumping into NOI growth or deceleration. Preface this with, first quarter was a little bit bumpy, but there's some drivers here that are a little bit of an anomaly, which I'll touch on when I show the property breakdown. But, the stabilized portfolio down about 8.5% quarter over quarter. A lot of that had to do with a couple of drivers, few properties being reset for real estate taxes, few properties getting fully staffed in terms of payroll, and then some occupancy dips, right? And having to, incorporate concessions back in the short term to get occupancy back up. So those are really the 3 main drivers around it. We also had some properties that had, record NOIs in Q4. So you'll see when we get to the year over year, that's kind of more important in terms of stabilization. It's giving us our trends and where we need to focus our efforts, that's for sure, for the next quarter in terms of tightening things up to get this number back to incrementally positive. But on the recently acquired assets, we're up about 1.7%. Obviously, the developments, you're coming from a place of 0 and a negative NOI, so we're seeing meaningful growth as we occupy units on the NOI side. And, as we break down each property here, you can see, some of the big movers. Again, the Creekside portfolio, real estate, the main driver there was the units that came offline due to the hot water tank issue, real estate tax reassessment, and some increased turn costs and R&M in the short term. Views at River Bend, another one that drove kind of the downward pressure there. Higher turn volume, full payroll, vacancy increase, concessions, and a lot of hangover from we had a manager change there. So there was a lot of invoices that were, that should have been paid in Q4 that were paid in Q1 basically to get cleaned up. So we actually brought back a manager that was with us prior, and he's fantastic and has got the ship back on course fairly quickly. Very lucky to have him back. Crescent Place had a tough first quarter, but we're going to see that improve Q2 pretty materially. So it was coming into first quarter with, heightened vacancy, evictions, turn costs. We're now at a place where the property is 97, 98% occupied. So we should see things normalize in Q2. Cobalt Row was an accrual thing for utilities, that happens, and it's consistent with Q1 2025. So again, nothing too alarming. Obviously, our goal and our focus in a market where you don't just get free, you have to give free rent. You're not getting market rent growth organically. You have to really earn that NOI growth. And that's through just really aggressive expense management, trying to be at, top of market occupancy, strong collections, low bad debt, other income, managing, expenses, managing, your big ticket costs very, very effectively to get that incremental growth, being strategic on your renewals. It's blocking and tackling at its best right now. This is definitely an operator focused environment. The days of buying assets and just, waiting for rents to grow and selling it in 2 years because your rents grew 10, 15%, those have come and gone. It's all about earning occupancy, and, I feel pretty good about where we are, despite some of the market headwinds, that we're still facing in a lot of our submarkets. I think we've got great assets, and we've acquired these assets with a mindset of, are these properties we want to own for 10 years in markets we want to be in for 10 years, and are we capitalized appropriately to own it for 10 years? And there's not one asset that I'd say, oh, I wish we didn't own this asset today. I think we have a fantastic portfolio that will win as the market begins to continue to normalize over the next 12, 24, 36 months. And we're going to be very, very well positioned to take advantage of that when that time comes. So here you could see, just as a follow-up for, again, following the same format, recently acquired Palms at Edgewater, some incremental movement forward. I think we're going to see that number continue to grow quarter over quarter as we work our way through the reposition there. And the Ash, obviously, great to see that moving in a positive direction from an NOI perspective as we complete our lease up. So as referenced earlier, in looking at kind of Q1 year over year now, so taking the stabilized portfolio where we have the operating data and saying, okay, how are we looking on a rolling year over year comparison? We've got 6 assets here that fit in that basket. Q1 over Q1 26 over Q1 25, we saw about 6% growth, year over year on that portfolio of assets. And as we continue to own deals for more than a year, we keep shifting, they'll be shifted into this basket. And this is really what we want to see, is how can we drive, long-term value. Our business is not short-term. People got skewed in, 2021, 2, 3, thinking that this was a short-term business. We've never gone into these deals with the mindset that we're going to sell them in 24 to 36 months. I'll never forget, even with several of our investors used to always say to me, like, why do you raise all this extra capital up front? You can just call it in the future if you need it, and you might not need it, if we sell it earlier. We go into these deals and operate them as if we're going to own them for 10 years at a minimum. And if the market allows for it, the same way we're opportunistic buyers, we'll then become opportunistic sellers. But our job is to protect your capital first and foremost, and then look to create long-term value, both for our investors, our company, and quite frankly, myself personally, I'm heavily invested in each one of our assets on a personal level, along with our business here. And we're looking at this saying, okay, we can consistently grow NOI and compound it year over year. We know we're battling through some challenging times. We're going to create long-term value. We look to generate, cash flow distributions along the way. We're not going to suck our properties dry. We want to be able to invest in them, because if our properties are positioned well, what's happening right now, not to digress too much, is there's a lot of groups out there that bought in 21 and 22. They've exercised their extensions. They're now at the end of their loan terms. And you're seeing these assets firsthand, because we're getting them sent to us on a day-to-day basis, that they've been sucked out of cash because interest rates ripped from 3.5% to 6%. So their debt service doubled. They no longer have free cash flow to reinvest into their assets, right? So then you start to see the downward spiral of these assets happen, where you start laying staff off. You don't pay your vendors, so your grass is, a foot tall, and you're not getting prospects in the door because your curb appeal is horrible. You cut marketing. You take the stove from the vacant unit to fix the stove in the unit that's occupied, and then you don't have the ability to rent that unit because it's not made ready. So it's a downward spiral. We're constantly looking at our portfolio on a daily basis, but with a mid to long view on every decision that we're making in our portfolio. So yeah, we are willing to sacrifice, rent growth, and admit if we were too early on something, hey, you know what, this market we thought was going to turn a little bit quicker, but we're sticking to our plan. We're going to continue to drive operations, drive occupancy. We're looking at it more of where this deal is going to take us in 3, 5, 7, 10 years versus the next 12 months. So every decision we're making is about trying to get that incremental NOI growth year over year, so we can compound and build long-term value while protecting the downside for our investors. And that's why we're adamant about our leverage. We sacrifice return projections on paper in exchange for longevity. There's our portfolio, if you look at it, if you slapped more leverage on it, the pitch decks would look better, the returns would look higher. But again, we want peace of mind, and we're in this more for the mid to long view and long-term wealth and value creation versus the short term. And not every investor is aligned with that, and we totally understand that. But we're very kind of transparent on it, where I'd rather go out with a 14 to 16, assumption from an IRR basis that we can stand behind and know, okay, if we miss in a year or 2 years and we get back half that over years 5 through 7, we're still in that 12 to 15 range. We're not going from 18 to 20 to 0 because I used, preferred equity and I'm levered up to 85%. I digressed a little bit here, but good to see on an annual basis the incremental NOI growth. So you could see here broken out the assets year over year, their performance there. So Crescent Place, was down. Now, again, keep in mind, Crescent Place was probably one of our biggest challenges. It was the one deal we bought in 2022. We executed it was a 1970 property, executed our renovation plan flawlessly, $5 million renovation. It was owned by a 25-year plus long-term owner-operator. Property had $988 rents. We went in, did a $5 million renovation to it, re-tenanted the property, and had the rents up to over $1,550 almost within a matter of 24 months. So we were able to execute a refinance on our bridge loan, got out of that, but as that was happening, elevated interest rates there, so that restricted our proceeds on the refinance. And then the market started seeing meaningful amounts of supply being delivered in 24, 25. So we had to take those rents down because we were bumping up against some of the Class A product, and we were a 1970s townhome product. So we're seeing that kind of revert back. However, again, we had some occupancy dips along the way. We're back in a really good place there. Latitude at South Portland, sees good, consistent NOI growth. Exchange at Rock Hill, Farmhouse, Cobalt Row, Belmont Heights, which you'll see shortly. It's a deal we actually sold. It was the first purchase of kind of our new re-entry back into the market in January of 2024. We've since sold that. We'll touch on that later. So for the quarter, just on the existing asset portfolio, we invested close to $1.68 million, close to $1.7 million of capital improvements. A lot of that attributed to our recent acquisitions within the last kind of 6 to 9 months and an ongoing renovation program that we have at Views at River Bend. So Townsend Pryor, 119-unit townhome property in Wilmington, we acquired from a long-term owner. We put in some outdoor recreation space, as you can see on the screen here, some grilling areas. We're doing some renovations. The community in Murfreesboro, Tennessee, from the long-term ownership group really didn't have any amenities. They had a pool and a small office, so we took the old maintenance area, which was a pretty large space attached to their clubhouse, attached to their leasing office building, essentially. Gutted that out, and we're converting it into a pretty awesome fitness center. We're enhancing the pool area, outdoor kitchens, dog parks, etc. So, Mike in our office is our VP of construction and CapEx, and he's on the road often. He's on the road this week as we speak, overseeing all that. In addition to our developments, we did about $13 million worth of construction draws on our development projects across the board. So our distributions for the quarter, as a result of all these efforts that we just outlined, for the stabilized portfolio, which is about $125 million of equity allocated to those deals, 1.815. We didn't have any capital events there like a refinance. Total distribution, 1.815, 1.45% return on the equity. And the recently acquired assets had about $365 million of equity allocated to that portfolio, $390,000 of distributions, about 0.6%, for total distributions of $2.2 million on $190 million of equity, which is about a blended 1.15% return on equity. So again, very proud of it, not blowing the doors off in terms of numbers, but we are really working very hard to provide consistent distributions through a challenging operating environment to our investors as we focus on long-term value creation. Obviously on the development side, we don't do distributions until we hit our capital event, which is, primarily a refinance. We, for the most part, look at our developments as longer-term holds. We're not merchant. So we typically look at those as, hey, we know that there's going to be no cash out for probably the first 3 to 4 years at best. And then let's do a refinance, stabilize the asset, and hold it and build, again, long-term value in an institutional quality property. The equity does take into account 2 assets that we literally just acquired, which is close to about $30 million of equity that was allocated to those 2 recent purchases in Q1. So a little bit skewed. We're dinging the total equity and the return percentage based on equity that came in literally 2 months ago. But again, consistency. Some of our deals we do, like Crescent Place, we only look at semi-annually, so that's not going to be a quarterly distribution. Others are going through a big reposition the first year. We know that they're not going to distribute for 12 to 18 months until we get to the other side. But again, our goal is to, provide kind of, a consistent operating distribution that will grow over time, but focus on driving capital preservation, asset preservation, and long-term value for our investor base. So that was our full operating report for the first quarter. And we're going to do part 3 of this is a looking forward, some recent announcements for the company. So again, that's a separate video update, but I want to thank you for taking the time to review this. If you have questions, please reach out to myself, Rebecca Windsor. Chris Gorman's going to be a little bit busy for the next couple of months with his newborn, knock on wood. That's coming any second. And, we appreciate all of our investors' support. And those of you that might be interested in investing with us in the future, again, please reach out to Rebecca at urscapitalpartners.com. Thank you.